Hello, hello, hello. Thank you for joining me today. It's currently 4:30 p.m. Eastern Standard Time. In today's quick webinar, we're going to be talking through our meta trade, but we're really going to start from the beginning. And I hope this deep dive in meta gives you an opportunity to think about trades a little differently. Trades that can take a long time to really see a lot of profit, but the profit is immense, can be some of the best trades that you ever take in your entire life. We're going to talk about momentum versus duration. We're going to talk about a setup that we call our COD setup, which has occurred 3 times on this meta chart. And then we're going to focus on the specific play that our trader IWB Bond, aka Dustin, took back in November that was able to net him the $100,000 plus profit. So we're going to go ahead and start off with that. It's a little bit of marketing, right? Might as well. Let's pull up the Discord really quick just so you can see. So we've been tracking this trade with him for a while. It was a big winner, but obviously the gap up on Friday really put it over the edge. There's his profit picture. Now, I do want to point out that Dustin in particular is not a small account here. We don't generally work with small accounts in the trader development program, but he is on his 3rd year with TTI. So it's not like this was an overnight thing. This has been years in the making. Quickly, I will show you his, actually, I don't think I have it up, but he was able to gain 97% on his account last year. We have 6 traders in TTI within the trader development program, at least, that doubled or better their accounts last year. So Dustin is within that realm. So congratulations, Dustin. When you watch this, I know you will. We're rooting for you, and we appreciate you giving us the opportunity to talk through a really awesome trade to help educate a newer crop of traders. So without further ado, let's get into it. I want to focus to begin with on this idea of momentum versus duration, and that comes down to volatility. So remember, the way that we break trades down is going to slightly be different than everybody else. Everybody has their own little spin on things, and this concept of momentum versus duration can really be boiled down to how long do you expect the trade to take? And generally that is a construct of the volatility. There are 2 basic volatility indicators that we use inside of the trading initiative. We use ADR. Your ADR is your average daily range. And what that does is from peak to trough, it gives you a general idea on average how much something moves within whatever time frame you're looking at. So in our case, the daily chart, the ADR of 2.12 shows that on average, meta moves 2.12% from peak to trough. That doesn't mean that it closes on average 2% per day, but the range on an intraday candle is generally 2.12%. ATR is your average true range. This is your volatility during a given look back period, and it includes overnight moves. So for example, gaps. Whereas ADR is focused exclusively on intraday, ATR focuses on the entire price history. So that's an important distinction because your ADR and your ATR can be wildly different. So if you ever find yourself in front of a ticker that has a relatively small ADR and a way higher ATR, you can reasonably assume the reason why the ATR is so high is maybe the stock is gappy. It gaps a lot. Makes sense, right? ADR is always going to be a percentage-based volatility indicator, and ATR is always going to be a dollar, or whichever currency you're utilizing, denoted indicator. So ATR of 866 legitimately means $8.66. ADR of 2.12 means obviously 2.12%. So the reason why that's important is when you're looking through different types of trades, and in TTI, we trade high beta or high volatility in short bursts. That would be something like a momentum or a burst trade. And then sometimes we will trade lower volatility, lower beta that take maybe 120 to 180 days to play out, which would be more duration. Both trading styles can be profitable. Generally, as a trader, you will gravitate towards one or the other. A lot of it has to do with your time schedule, to be honest. If you have a little bit more time on your hands, maybe you can get away with trading more momentum types of trades. The quick bursts make sense. Reason why is because generally these could last anywhere between 3 days and we'll say 15. I'm just kind of spitballing that, but they're generally faster trades from a swing trading standpoint. And your duration trades can be anywhere between 45 to like 120 days. So if you're not in front of your computer all the time and you don't want to have the responsibility of needing to close something intraday if some sort of limit gets hit, maybe duration is the way that you should be trading versus momentum, which are obviously going to be more active, more hands-on. The reason why this is so important is when we look at a mega cap like Facebook at 2.12, it's reasonable to assume that this is going to be a duration play. This is probably not going to be a momentum play. You're not going to see Meta generally move 20% per day. Although Friday we did. But we generally don't. Even when we gap up, we don't move that much. So it's a slower play. If you're trading options, what does that mean? If you realize that this is probably going to be a duration play and you're going to need a little bit more time or expect a little bit more time when you got to the options chain, we'll look at it right now. What's the first thing you should look at? Probably not the monthlies that you're in. Probably not the next month. We're generally looking 90, 120, all the way down to 180 days out. Give yourself enough time to actually allow the price movement that you expect is reasonable to play out. Whereas a momentum style trade, maybe you can get away with the very next month or the month afterwards, anywhere between 45 to 60 days. Maybe that's okay. So expectations of a trade are very important from an option standpoint because you're legitimately buying time. Theta is one of the variables you are paying for, so you need to understand what type of trade you're in. Also, if you're trading shares, we have lots of guys inside of TTI that have large accounts that trade shares. Understanding whether it's more of a momentum style play, a duration style play, will allow you to sit comfortably in a trade that might be taking a little bit longer to get moving. If you're in a trade and you consolidate sideways for 10 to 15 days, well, if you went into that trade expecting quick moves and you don't get it, you're probably going to stop out because the trade idea isn't valid. But if you went into the trade expecting it to take 3 to 6 months and it doesn't do anything for 15 days, might not look great, might not feel good, but you're not going to stop out because that's part of the game plan. So understand when you pull up these types of trades and in general, take a quick look at volatility. Then ask yourself, what are you trying to trade? The quick momentum burst, or is it more of a duration style play? Now, once again, Meta is going to be a duration play, so we're going to go ahead and keep this up here. Meta is a duration play. It doesn't move a whole lot on average. We're going to want to capture large swaths of time expecting that this was going to move up, and it did. This has been one of our best tickers over the last 14 months. So once we finally came to the conclusion this is a duration style play, the next thing I want to point out is the fact that this particular chart, if you think about when the market bottomed in 2022, on an absolute basis, the bottom was October 13th. On an absolute basis, quite literally, you cannot argue, SPY bottomed on October 13th. When did the Qs? The exact same day, October 13th. When we look back at Meta and we compare this to some of the other Mag 7s and other large cap, tech in particular, stocks, Meta bottomed almost to the T when the market bottomed itself and started its gradual ascent, whereas other big names still were selling off. So Meta had actually, this would be somewhat like a capitulation movement, bottomed out before a lot of the other mega cap tech stocks. In this case, it would be a calm stock. Excuse me if I mix that up. It's a communications name, but I'm just going to call it a tech stock. Now, this caught our attention, not necessarily this part, but early in 2023, we had made note that Meta, and we had not bought it yet, so don't let me sit here and make it think like we bought it off of the lows. We did not. We started looking at it as it was starting to flip the 200-day moving average because it was one of the first mega cap stocks that was. It was already up 72% by the time we even looked at it. In TTI, we don't try to time bottoms and we don't try to time tops. Need to make that evidently clear. We just catch a ride on strength when we see it. Think back to the beginning of 2023. Nobody wanted to be long anything. It was a scary time to be long. Everybody thought that was what we were seeing was a bear market rally. By the beginning of February, Meta had already regained nearly 80% prior to the gap, 76% and flirting with the 200-day moving average. The first gap up on earnings at the beginning of February was our signal inside of TTI that we needed to get long Meta. This was now shaping up to be a market leader if that was the bottom on October 13th, which in hindsight, we made the right call. We were going long in Q1. It wasn't easy. We got chopped up quite a bit. It ended up doing very well for us. But the gap through ER was our first real pointer. So we're going to get into this idea of a COD setup. This is a setup that we trade inside of TTI. And it's special in the way that we trade it. COD. We model this specific setup off of a setup that is popular on FinTwit, called it EP. But we trade it in a different way enough to where it's not okay to call it an episodal pivot. We call it a change of direction. Let me go ahead and explain that really quick. Let's get rid of this stuff. What we're looking for, which is similar to an EP, is a gap. And in this case, on earnings, we would consider this something called a PEG, a power earnings gap. Power earnings gap signals to us that there is a change in market sentiment for the stock. Something happened. It doesn't have to be an earnings play. In this case, it was, where the market said, uh-oh, we need to own this right now. Whatever sentiment that had influenced Meta to drop from its peak to trough from nearly $400 to $88, a 76% reduction, something changed in early of 2023. As technical traders, and myself especially, I don't care what actually changed. What I do care about, though, is identifying that it did change. All right, and I think that's very, very important. So we saw the PEG in Q1 of 2023. And we initiated what our COD setup is. And what it is when we can scan and find some sort of PEG. The way that most people trade these EPs is that they immediately buy, set some sort of stop, and then let these things continue to go. Because this is a powerful indicator that the market is going to want this stock at a higher price point. Inside of TTI, we don't want to just indiscriminately buy. Plus, we have a longer time frame. Right? Like I said, sometimes we go out to 180 days. And so what we like to do is we like to take the high of the PEG, which would be somewhere right here, draw a line, and buy on a resumation of the uptrend. It's just a horizontal level break. In this case, Meta ended up being a rounded bottom. It's a cup and handle, which we were able to front run the breakout of. Josh, if you're listening to this, thank you. You're the one that called that out. Made us a bunch of money. But realistically, the standard entry would be right here. We would simply wait for a resumation of the uptrend. Now, once again, this was Q1 of 2023, and everybody was still bearish. Everybody, understandably, was afraid we were going to hit new lows. But in that, there is opportunity. I highly encourage you to go back in this channel and watch the video that I put out in March of last year that was talking about how bears were going to get slaughtered in 2023 because market leaders were starting to lead again, and that typically doesn't happen during bear market rallies. This stock at this point, when I had put out that video and everybody was screaming about the regional banking crisis, if you remember that, was up 126%. This doesn't happen in bear market rally territory. So we had bought the COD setup. Some of us had bought and front ran the cup and handle break, but the official entry was somewhere near 195, and our price target was near 230. Now, I'd like to tell you that we absolutely sniped the close, but we didn't. It was totally on accident. It was luck. But if anybody tells you that there's not a significant amount of luck in trading or investing, they're lying to you and probably trying to sell you something. There's a lot of luck. We had targeted the 230 to 235 area in particular because of the cost of the call debit spreads. That was it. We held through the gap after taking half off at 100%, and we were able to close into the gap up post ER. Obviously, we were forced to because our call debit spreads were damn near maxed out, and we weren't going to let these things go to expiration for a couple pennies more. But then we had another decision. We had a call debit spreads on the books that we closed because we were at max profit or near. But this stock had just done what? Another PEG. This is yet again another power earnings gap. So if you had already taken the trade off of the first power earnings gap, in what world are you going to not take the next power earnings gap? At this point, we were for certain that we were in a bull market. Our idea was we were going to be near all-time highs at the end of 2023, which we got very close. And so what do you think we did? The exact same setup. We bought the horizontal level breakout on the resumation of the uptrend. Now, let me point something out before we go into the third entry, which is where you see the $100,000 profit. It's easy in hindsight to describe this to you, but it wasn't necessarily easy to trade it. And once again, if anybody tells you that trades are easy, they're fucking lying. They're simple. None of this stuff is rocket science. But it's not easy. This particular trade on Meta, more than 1 month we sat there and waited to own it, which is why if you ever read any of my content or listen to the videos that I put out, the number one thing I bitch about all the time is for those of you that aren't suffering from short attention spans, from those of you that aren't impatient, there is an incredible amount of money you can make in the market right now because everybody has TikTok brain. Everybody needs that dopamine hit every 2 seconds or they move on to the very next thing. And therein lies the problem. Chasing the next shiny object. We waited for 40 days to buy Meta. And it worked. The very next PEG. What do you think we did? We waited 16 days this time. We bought it again. 320 was the price target. We hit 320. Once again, a little bit of luck. So we were 2 for 2 last year, coming in towards this third entry, which I'm going to show you the write-up as it is. Unfortunately, we weren't using our market research portal back then. I have the trades written up, but I don't want to dig through Discord to find them. But I will show you the third. So look at the chart first. This is what we were working with. And if you remember from May through end of July was post-regional banking crisis and everything flew. The entire market flew. If you look back at your yearly P&L last year, it's probably going to look like this if you were profitable at least. Big up and then a down, maybe a little bit, and then a big up, and then however you finish the year. This was end of May through end of July. This was this area right here. Everything corrected. The market from late July through late October went down. Look at SPY. Remember trading through this? That wasn't fun. Let's look at NASDAQ. Remember trading through this? That wasn't fun. If you were throwing cash at the market like you were from May through July, you lost money probably because it wasn't the same market condition. But what did Meta do? Look at the slopes here. How many of you guys remember the word slope from high school? Look at the slope of SPY during the correction. Look at the slope on the Qs during the correction. It's down and to the right. Don't have to be a mathematician to see that. What's the slope on Facebook? Is it down and to the right? No. Once again, you have a couple brain cells and they're rubbing together right now. You're going, that's a horizontal channel. So let me ask you a question. If SPY and the Qs are going like that, and Meta's going like that, and I ask you, which is the stronger of the three, what would you tell me? Hopefully you'd tell me, well, the horizontal channel is stronger than the downtrend. And as a matter of fact, I can prove it to you by utilizing something as simple as a ratio chart, dividing the absolute price action of Meta against the absolute price action of the S&P 500. The zone that we're looking at here is late July through late October. Where is it? Here. The market went down and Meta went up. What does that tell you? It's the first pillar, well, the second pillar of TTI. First pillar is only price pays. We don't give a shit about anybody's opinion. Number two is relative strength. Why does this matter so much? Well, we don't focus on buying everything under the sun. We focus on buying the strongest things under the sun. So what did we do here? We said, well, Meta went sideways when everything else in the market was going down, and this is a mega cap. That's a big clue to us that this is going to be a leader in the future when the market stops going down. We had no idea when it was going to stop. So we had initiated a buy, and we bought between 305 and 315 right here. So I'm going to go ahead and pull that up really quick, and I want you to actually read through the trade idea here if my browser works. Is my browser going to work? Or what's going on here? Let me try to reload it. Just doesn't want to load, huh? Why do I use Edge? That's my problem, right? Using Edge. Bear with me here. I want you guys to see the actual write-up. If I can get it going, Edge just doesn't want to work. Let's restart the full thing. All right, I think I got it. Let's get it over to, let's see here. There we go. So this is our market research portal. This is what you have access to if you sign up for either of our services, either the market research portal bundle on a quarterly basis or the trader development program, which is a 1-year deal. So we're going to go through trade ideas here. We're going to type in Meta. And I want you to look at the actual trade idea that we put up back in November. So November 2nd. Once again, I'm going to go over to TradingView, and I want you to see what the trading environment was like when we put this out. I'm not lying when we got pretty close to timing the absolute bottom. As you can see, the market bottomed like the 4th week of October, October 27th or something like that. October 26th, excuse me. And we were buying it on November 2nd, which is right here. I mean, there's not a whole lot more proof I can give to you other than maybe order numbers. Okay, so let's go back and let's read together the actual trade idea. Here was the chart at the time. Now, let me ask you something really quick. If you guys have been watching any of our content, you probably know that we like buying breakouts. Think about it really quick. Why were we willing to buy Meta in the middle of a range? Why were we willing to front run this breakout, which we don't do often as a community? We really don't front run a whole lot. And actually, one of the biggest things that I try to teach people not to do when they join the trader development program is to front run. When it works, and in certain market conditions, it's fantastic, but it doesn't work often. That's the trade-off. High risk, high reward. You front run a trade, there's an added risk that the breakout is never going to actually manifest and your loss rate goes sky high. So if you're not managing your position sizing correctly during front runs, you can very quickly lose a significant amount of your portfolio with just a few amount of front runs. So we don't normally do it. Think to yourself why Meta made sense. Think about that relative strength concept we were talking about. SPY and the Qs were going down. The communication sector was going down. Everything was going down. Meta was not. So we extrapolated this out and we said, listen, if the market bottomed on October 26th, comms looked great. The communication sector itself, tech and communications and consumer discretionary all looked good. We knew this was the third trade we were going to take on Meta. Both trades prior were huge wins for us. This was probably going to keep leading. I mean, this was a market leader, and for whatever reason, the market didn't want to sell it off when everything else was. Let's get back into it. And our original stop loss was below the range, which makes sense from just a basic technical analysis standpoint. If it breaks the range low, you want to get out. So we took the liberty to front run the breakout. Now you can see some of the stuff that we do here inside of TTI for the trade ideas. This is all important information. Which sector is it? Because obviously we want to be trading the strongest sectors that we can at all times. There's huge edge in that. Industry info as well. Sector and industry kind of go hand in hand, so we always label that. Stock information. Remember, go back to the momentum versus duration idea. Why does it matter about market cap and volatility? Well, that drastically changes your expectations of a trade in terms of time frame. If we're trading a large cap at $800 billion with at this point, 3.01% ADR, it's actually kind of high for a large cap. I'm thinking about it now. Is it reasonable to expect that these things are going to take a little bit longer to play out? Yeah, it's an $800 billion stock. It's not a small or a mid cap. So we always put the stock info, but then we got the risk levels. Risk on above 305. So we're going to put the actual trade on the chart in a second. Risk on above 305. Risk off below 285. And our first profit target is 380. And then we updated it as the trade kept moving, right? Because we don't want to stop out of trades as long as they're working for us. That's a big thing. We'll talk about that in a second. So let's actually go and build this trade on the charts. We said 305. Entry price of 305. We had a stop price of 285. And we had our first profit target. This don't make no, yeah, it is. I was like, this doesn't make any sense. I couldn't see the left-hand side. And then we had a profit target of 380. So this was the first iteration of the trade idea. Back when nobody wanted to own anything. Look at this. From a shares perspective, this is above a 3-to-1, a 4-to-1 if we were able to buy on a pullback. This is a great trade. For those of you that don't know, a 3-to-1 break-even win rate, if you're targeting at least a 3-to-1, is a 25% break-even win rate. Meaning if you're targeting 3-to-1 setups, you only have to win 25%. Theoretically, over a large sample size to make any money. 4-to-1, which is, it's closer to 4-to-1, is a 20% break-even win rate. So think about that. When you're setting trades up, the risk to reward model is very important because your win rate is a product of the risk to reward setups that you trade on a consistent basis. So this 3.75 to 1 setup was the original trade idea. And before I go any further, I just want to point out Meta worked. It was a little bit slower of a trade. The market was ripping, by the way, through November, and we were in lots of small and mid-cap growthy names, some software, semiconductor. We posted a lot of them here on YouTube. You can see some of them. They went nuts. And Meta was doing Meta stuff up and to the right over time, which is great. But it wasn't keeping up with the rest of the market. So when Meta started to pull back slightly, we had questions, which undoubtedly anybody would have. What do we do here? The contracts that we had bought were probably negative at this point. The shares that we had bought were rapidly losing any profitability. So we had to make a decision as a community. What do we do? Do we want to give all of the profit back and wait for a stop out near entry if it gets down there? Do we want to stop out now and then re-enter on an additional breakout? What do we want to do here? It's a difficult, like I was saying earlier, none of this shit is easy, guys. It's simple in hindsight, and it's very simple if you have whatever system you have implemented. If it's only a couple moving pieces, it can be simple, but it's very hard to manage trades. That's not the easy part. People, Trading psychology, man. These are like fucking buzzwords that 22-year-olds regurgitate from YouTube. That shit means nothing. This is hard to hold through a pullback, especially as a swing trader. It's a multi-day pullback. Meta peaked on the 22nd, and by the 5th of December, it had drawn back 7%. Hard. But let me put you in our minds really quick. The conversations that we had were essentially, is the uptrend still intact? Well, yeah. Uptrend isn't intact anymore until it breaks down below at least our entry and we're back in the middle of the range. Is the market still going up? Oh, yeah. Did we break below the 40 with the RSI, which would signal to us that maybe there is a break of bullish momentum? No, it didn't. Did the 200-day moving average start to give us a little bit of cause for concern? Was it starting? No, it wasn't. As in, the shorter-term moving averages weren't really reacting a whole lot either. And so we made the decision. We're going to let this thing ride until entry. And if we break below the original entry, we're going to stop out. In hindsight, right call. When it was happening, it was difficult. Why? For the shares guys, because we have guys with 7-figure accounts trading shares, they're giving up an 11 to 12% move. And at the time, they were already down 7% off of their highs. So they gave back a significant portion of whatever they, and once again, this is a duration style play. So over the course of 36 days, they were only up 4%. That's not fun. And the options guys were negative here. Anybody that had bought options, and if you know how to swing trade options, these things can fucking kill you. The loss on premium on these things, if you're not emotionally ready for swing trading options, can absolutely destroy you. So it was a difficult decision, but it was a decision that we made. Then obviously we saw Meta bounce. And I think, honestly, the hardest part about this trade was this decision here to hold the complete size, which, by the way, not everybody did in TTI, which I'll show you really quick. Joan, you're probably going to watch this, and we love to use you as example here. We have a trader that joined TTI who just started trading in June of last year. June of last year. So from June to the end of July, he was trading, and he has a large account. Let's see. These are shares. From June to July of last year, the market was ripping, and so he made a lot of money. But then from July through October, the market went sideways to down, and he lost a lot of money. You can't trade the same market environment. That's when he found us at the end of October and said, I need help. And so he's still new. He's still going through the reps, and he's learning quickly, but still there's growing pains here. The reason why I bring him up is when we go back, he did stop out on the pullback because the emotions can be crippling. The self-doubt, is this trade dead? Should I get out and get whatever profit I can? My number one piece of advice I can give anybody that suffers from that specific crippling emotional response is, and I'm on an ivory tower as I'm saying this, but is the trade idea invalid? The trade that you put on, is it invalid during the latest pullback? Does it invalidate a moving average that's part of your system? Does it invalidate a level that's a part of your system? Is there something in there that invalidates this particular trade? If not, continue to let the trade work. Try not to get in the way of it. The way that I try to teach this in TTI, most of the guys in TTI are either professionals. Nobody is a fucking bum inside of the trader professional group. Everyone either owns a company or they're a professional. Like, no one's there with a small account bumming shit around with small Robinhood accounts and stuff. And so this example that I always bring up is micromanaging. How many of you guys have been hired for a position and your boss is down your fucking neck telling you what to do every single day? And you're like, dude, this fucking sucks. You hired me to do a job. Let me do the job. What happens to your performance when you have an asshole breathing down your neck? Your performance suffers, both from being terrified that the guy behind you is going to find something wrong and rat you out, but also you're just pissed. You don't want to work somewhere where somebody is pulling your strings like a fucking puppet. Same thing with trading. Don't micromanage your positions, especially if your time horizon on the trade, once again, duration, is 180 days or potentially even more. If you're looking to hold something for 180 days, or at least that's the expectation, and this thing pulls back over the course of 2 weeks, 14 days in a 180-day expectation trade, if it doesn't invalidate a level, the fuck is 14 days going to do? Don't let that stuff creep into you. Sometimes it's going to work. You're going to be able to get out of a trade and you're going to go, wow, that was a good stop out, and it's going to keep going down. But I'm going to tell you, over a large sample size, if your system has edge and you're getting out of the trade early to try to time every pullback and then buy the dip and time every top and maximize your P&L by doing more than you should, you're going to make some bad decisions over time. And the number one bad decision once you get over the hump of actually being able to find a trade that fucking works is something called opportunity cost. If you would have sold Meta here during the pullback, like our buddy Joan did, he would have made somewhere between 5 to 7% on his trade. Congrats. You made money. That's the first thing about trading. Can you do that consistently? That's fucking hard. But once you get over that hump, once you can figure out what's actually moving, as he eloquently says here, this one I opened on the 19th of January after closing it a few weeks back. Now, Joan's with us every morning, talks with us inside the Trader Development Program. We trade 5 days a week. This is more focused on people that want a more in-depth experience. They get to trade and listen to me scream at them all day, and it works. It's amazing. I say the same shit all day, and eventually it creeps into your brain like a virus, and next thing you know, you're holding trades longer than you think you should. You look at some of the base levels on these things, like 122%, right, where you take your first profit, 508% on Uber, 486% on Uber, 102, 309, right? I tell you, don't sell your fucking good trades early because some dickhead on Twitter or whatever is telling you that the world's about to end. Don't do it. So Joan did. And Joan, thank you for letting me use you as an example, but it was a learning lesson for him. He tried to time the market, got out when he shouldn't have, and the hardest part after closing a winning trade is trying to find the next entry in an uptrend. It's very difficult. FOMO, everything else creeps in. So for the rest of us, Joan obviously made money. It's a good trade. He's up, 10,000 euros on it. So it's not a bad trade by any means for him. But think about it. If he got in on the 19th of January, zoom in here really quick. 19th of January is somewhere here. Up 25%-ish, something like that, 19th of January. Am I crazy? That's about it. So he's up 25, 26%, something like that, as opposed to being up 56%. And on a large account, that's a big difference. That's a big difference, guys. So let's go back to the guys that didn't close. They let this thing continue to run. The hardest part about trading is not finding the trades that are going to break out. I'm sorry. I might be sounding like an asshole, but it's not. I've been doing this for 14 years. The hardest part is once you find yourself in a trade that's working, how do you maximize the reward while mitigating risk? You don't just want to throw caution to the wind and not give a shit about anything. But at the same time, go back to that opportunity cost standpoint. If you close your best trades early, you're going to significantly hinder your yearly P&L. I challenge you to go back last year. If you had a profitable year, look at how many trades really made that year. How many trades really pushed the envelope? It's generally a handful. It doesn't matter if you're scalping, day trading, swing trading, position trading. It doesn't matter. Something like 3 to 5 trades for most people really push your portfolio up. Most are going to be singles, doubles, some strikeouts. You're going to fucking piddle paddle through the market, and then all of a sudden a home run. Cool. Then you're back to singles, doubles, singles. And then next thing you know, you hit a home run, but that turns into a grand slam. And now all of a sudden you're in something where you're like, holy shit, this thing is up 1,500%. You might get 2 or 3 of these a year. If you fucking sell it at a home run, you significantly reduced your ability to push the envelope of your portfolio. So this is hard. This is fucking hard. Continue to say that. That's why we're in Discord together. We have these types of adult conversations. It's not what's SPY gonna do. Is Tesla going down today? Like, come on, bro. And it's not chart patterns. Like a fucking 5-year-old. Buy the symmetrical triangle. Like, Get into a trade that's working and then manage it. Maximize the R to R while mitigating risk. So how do you do that? I'll ask you guys a question. We had earnings. This is a real example from guys in TTI. We had a bunch of traders in Meta. You guys have seen Dustin's 100,000% winner. We call him a cowboy inside of TTI. We have a couple gunslingers where everybody, if you have a range here of not risky and we'll say very risky, most people fall somewhere in the middle, but probably a little bit closer to not risky, somewhere in here. And then you got the group of guys that live their life on this side of the scale. These are the guys that, if they have edge, have insane equity drawdowns throughout the year, but generally, like I said, if they have edge and they don't blow a fucking account, you see something like this, which is ironically what Dustin's yearly P&L looked like last year, something like that. So big swings. Reason why I bring that up is there's two different types of traders in TTI, and I'm a little bit closer here than here. Somewhere in the middle. Prior to ER, nearly everybody in the group was up multiple hundreds of percent in Meta, depending on what you grabbed. Some of them grabbed spreads, so they didn't have a choice. They basically had to close. For the guys that had shares or straight calls, which we'll talk about in a second, because if we go back to the trade idea, the actual trade idea itself was a call debit spread. So we're going to talk about the difference about buying call debit spreads versus buying calls in this type of environment and why one was the better choice. Coming into an ER event, we take profit at 100% first. That's I shouldn't put a negative, number one. The first place we take profit is at 100%. Do you know why? We sell half of the position. What happens when you sell half of the open position at 100%? You remove all principal risk from the trade. So at this point, you sell half at 100%. The only other portion that's still available is house money. Think about the casino. You're just playing with what the casino gave you. It's like going playing roulette. You go with $500. You throw it on red. You double your money. You throw the $500 back in your pocket, and you just play with the next $500. That's it. If you lose it all, fuck it. It's house money. It's not that big of a deal. That's the way we approach options trading. Shares are a little different, but we're going to focus on options right now. So we sold half at 100%. That allowed us to be able to hold a position risk-free on our books and not have to worry so much about the pullbacks, etc., which helps a lot. If you struggle with emotionally holding good trades during pullbacks, I highly encourage you to take advantage of selling half of your position at 100%. It really helps. Trade progressed. It was up anywhere between 400 and 500% for most people inside of TTI prior to ER. Now we're going to go back to Billy. Billy, I'm sure you're going to watch this. Billy is a gunslinger as well, but Billy had some cold feet on the meta trade. Don't know if he posted a picture of it because he was a little upset, understandably. I mean, I get it. Yeah, here's his meta trade. Now this was all the way back on the 26th. So this thing kept running. He was up 500% coming into the ER. Now let me ask you something really quick. This was already a free trade for Billy. He's up 500% at the day before earnings. Multiple contracts. Does it make sense to close the entire trade prior to ER? Or does it make more sense as long as you have expiration? I need to say that. And we did. These, I believe this tranche of contracts that we're trading are Marches. So we still have time left on this. Does it make more sense to close the entire thing and lock in profit, the entirety of it? Or does it make sense to significantly reduce the amount of risk you have going into a binary event like an ER report? If you're up 500% and it's already free, there's no risk against you. So a discussion that we had inside of TTI, if you didn't want to hold the full position through ER, which most people didn't, and that's understandable. Let's say you have 10 contracts left. Sell 7 of them. Lock in 500%. You have 3 left. If Meta bombs like Google did, which, by the way, factored into it, Google fucking bombed. AMD bombed. If you had trades going into Google or AMD, they got cut in half or worse. Lock in 7 of them, hypothetically, for 500%. Let the other 3 run. The worst that can happen is those 3 go to negative 100%, which was very unlikely, and you still get out of the trade with great profit. But something that not enough traders that are, like when you take the next step and you can find some breakouts that tend to work and you know that you have edge, but that creeping, that nagging feeling in the back of your mind that things can go really bad. Like it's almost like they feel imposter syndrome. Like, I can't believe that this is actually working. I'm going to fuck it up somehow. That thought process there told him to sell all 10 and lock it in. But that doesn't give you the opportunity to potentially catch from the home run into a grand slam. The best possible scenario you can be in, and this was why this is such a big deal, and I'm making the full fucking video about it, is that when you're up 500% and it's already free, there's zero risk against you, lock in however much will make you feel comfortable, but give yourself the opportunity to hit the fat tail event. Give yourself the opportunity to hit the grand slam. And he didn't. His 500% would have went to over 1,000. He made good money on it when he closed the full thing, but it wasn't 100 grand. It would have been probably an account doubler though. And so yesterday he was pissed, understandably. But that allows him, that experience, and I tell this to everybody that will listen, but specifically the guys in TTI, your biggest losses are never going to be the things that stick with you forever. Unless you're fucking Stanley Druckenmiller and you blow $1 billion of George Soros' money shorting the dot-com bubble, which he ironically said afterwards learned nothing from because he already knew he shouldn't have been doing it. What a gangster answer. The biggest losses are not going to be the things that sting the most. It's the fucking trades that you miss and go bananas and you're like, that could have just, you know what, whatever. Bought me the Lambo. Let me retire. My wife is going to stay with me now. Whatever you need. It's those trades that haunt you to your core. So if you find yourself in a situation where you can reasonably risk swinging for the fucking fences, please do it. Sometimes it won't work, but it will never work if you don't try. Don't just do it without any sort of risk management, if you will, right? Once again, it was already free. You can clip, and we were talking about, clip some off in before ER to secure some of it just in case it does go south. But it's still a great trade, even if the fat tail events to the left and Meta fucking dies like Google did. It's still a great trade. Good job. But put yourself in the situation to swing for the fences. Now, Dustin did. Dustin told you he's a gunslinger. He doesn't like to take profits unless it's at 100% or the price target is hit or there's a loss. The way that we do things in TTI is we sell half at 100%. We sell a quarter at some sort of predetermined price target. Generally, it's the 1.618 fib extension. That generally leaves us with 1/4 of our trade still on the books. And that last fourth is discretionary in nature, meaning you can close it whenever you want, but it's generally agreed upon inside of Discord that we want to close on either a loss of trend, so prices coming up and starting to break down, or a break of structure. Whenever the trade idea essentially becomes invalid, we want to stop out. We very rarely time the absolute top because of that. But we're locking in profits here, and we're locking in profits here. So this turns the trade free. This puts us in a profit. This portion is discretionary in nature in the fact that everybody can make their own decision. Dustin is a cowboy. He turns his trades free and then doesn't close at the first profit target. He's been with us 3 years, so nobody gives him shit for it. He closes the entirety of the trade once the trade idea becomes invalid. So he was running through ER with, at very minimum, half exposed. And obviously, we caught the big gap up. Now, I want to point something out. I just spent 50 minutes talking through the entirety of Meta, how we viewed it all year last year. So go ahead and pull it up on Explorer really quick. We'll talk through this in a second. 50 minutes of telling you exactly why we liked Meta all year last year. Different price points we bought it at, trades that we took. You've seen some of the profits, some of the good things we did, some of the bad things we did. gunning for grand slams for every single trade is fun in theory, but they're grand slams for a reason. They don't play out very often. So we generally bat for singles. And then when those singles turn into doubles, triples, home runs, and we realize that maybe we're in something, we manage it as a grand slam. So just want to point that out for anybody that's looking at this and going, I need to hit a play like meta. We all want to hit a play with meta with max size. But realistically, is that a winning strategy over a large sample size? Probably not. But when you find yourself in the situation to take advantage of it, you should fucking try to take advantage of it. Last thing I want to talk about really quick, and if you want, you can kind of read through this while I talk about it. You can think about leading communication stock. It's outperforming Google during the recent drawdown with potential to retest all-time highs. We're taking a little bit more risk in this trade and not waiting for the 325 breakout. All of this stuff is here. So for the guys that sign up for the market research bundle, full trade idea with actual write-up or a video, tells you exactly why and where we want to own it. It gives you conviction to hold the fucking trade and take it. Last thing I want to talk about is the difference between call debit spreads and calls in this type of environment, because that does dramatically change the outcome of the trade. Let's go back to TradingView. The play that we had agreed on as a group, and now I need to point something out. Not everybody has a 7-figure account. We do have a bunch of guys that have deep six and 7-figure accounts. That's the guys we market towards. But some guys, I like them. I feel like they got it. They're sitting with high 4s or 5-figure accounts. And so sometimes, and I don't want to go down this route with risk. I actually just put out a webinar on that last week. Please go watch it. I think it's called Risk Management 101 or something. I think Risk Principles 101. We talk about this concept called R and standardizing your position sizing in terms of risk, so you know exactly how much you can win and lose per trade. It really helps a lot. If you don't know what that is, please go back and watch that. This call debit spread here allows the smaller accounts an opportunity to get into a trade without paying like $800 per fucking contract. Meta is an expensive trade. For any of you guys out there that's traded Meta, you probably know that. As a matter of fact, Dustin paid $1,100, I think. $1,100? Oh, $1,010. $1,010 per call. And he bought a lot of them. He rode through ER with 10. So over 10 grand in exposure in that particular trade. A lot of people can't stomach that type of size, and that's fine. So these call debit spreads give us a unique opportunity to do two things in particular. Size down. So instead of paying $1,000 per contract, you're paying $85 per play. So that significantly reduces the amount of cost you need to enter it. And two, another unsung hero part of call debit spreads are the fact that you can clearly define your risk before you get in. You know exactly what your max risk and you know your max profit, like before you even get into the trade. In this case, we bought the 380, 385. You can see the price target at 380. Max profit of 415 for an 85-cent debit, meaning this was greater than a 4-to-1 setup. Remember, talking about that break-even win rate. For those of you, and this is the first time you've ever heard me talk, I say the same thing a million fucking times because it works. And I scream it to you until you believe it, and then you start doing it and you realize, holy shit, it does work over time. We don't target anything less than 4-to-1 from an option standpoint. Here's a great example of that. This is greater than a 4-to-1, so break-even win rate of 20. Win more than 20 over a large sample size, theoretically, you're going to make a couple bucks. Hopefully you do. I think I'm about a 45 to 50% win rate myself, so I'm decently profitable. Now, let me ask you a question. At what point does it not make sense to own call debit spreads? Let's go to the chain really quick. There's 3 main reasons why somebody would choose a call debit spread over a call. Number 1, most obvious, IV. Without getting into all of the Greeks with options, shares guys don't have to worry about implied volatility, but options guys do. And a lot of people that trade options have zero fucking clue about how hurtful or beneficial IV can be. So let me ask you a question. We have a threshold of 50. Below 50, we want to buy calls. Above 50, there's a little bit of wiggle room. Above 50, we want to buy call debit spreads. Why? It's a simple answer. There's a little bit of a threshold there. Above 50, the odds of IV continuing to expand, particularly when looking at IV rank up here, which is a tasty trade tool, but I think most brokerages have implemented it now. This takes a historical look on current IV in terms of 52-week highs. So where are we right now? We're very low. In a high IV environment, which we set at 50 or above, the probabilities that IV will continue to expand are rather low. So what happens when you buy a straight call and IV decreases? You lose money. IV crush, we've all been there. It fucking sucks, especially when you choose the right direction. The stock goes that way and you still lose money and you're sitting there like, how the fuck did I say it was going to go up? It went up and I'm losing money. It's because you're probably getting crushed due to falling IV. So when we're looking at the options chain here, Meta in particular, we're going to look at some trades right now. We can do this live. I don't know what I'm going to pull up here. I haven't looked at this. Let's go out to the Junes because that's kind of where we're buying right now. All the trades that we're looking at from the long side are Junes. The short side are Marches, by the way. For June, we want to go out. When we look for the 0.25 delta, statistically within our time frame, that 0.25 delta is the sweet spot for us in terms of risk to reward, how much we're paying, etc. We didn't make that up, by the way. Shout out Tasty Trade. These guys have been trading options for 20 plus years. They put out all this incredible data on options, and we just fucking piggyback off it. Listen, guys, stand on the shoulders of giants. If they want to go through and tell us they're the fucking brokerage, like they have all the data. If they're going, listen, if you're a swing trader trading 45 to 100 days out, 0.25 is your sweet spot. I'm like, all right, I believe you. Like, they're the guys. So we started this 3 years ago, and it's fucking worked. So we've stuck with this 0.25 delta idea. Once again, if it's too expensive right now, these contracts are $1,400 per contract. That could price somebody out. If we want to go and buy, like we always buy in twos in TTI. Remember, we want to take half off at 100%. So we try to push people into buying twos, 2, 4, 6, 8, 10, 12, whatever, to sell half. If you buy 1, 3, 5, 7, 9, etc., it's an awkward distribution. You can't sell half. So if this is too much, if, for example, around $3,000 is above your 1R, the next thing you can do is turn it into some sort of call debit spread. Now, this reduces the overall payment from $1,400 to $100. But let's go back to that IV discussion. IV is less than 50. Do you want to buy a call or a call debit spread? Well, if IV is less than 50 and IVR is rather low, what are the odds that IV expands? Goes up. Probability that IV expands goes up. If you're in a straight call in an environment where IV is expanding, you are making money multiple ways. Assuming you chose the right direction, up. With IV expansion, you are now gaining premium two different ways. IV expansion builds premium. IV contraction breaks away premium. So if you sell stuff, you want IV to contract. If you buy stuff, you want IV to expand. What do call debit spreads do? They hedge against IV contraction. By selling something further out, this particular call that you're selling likes when IV contracts. The call that you're buying dislikes it. So there's a counteract. It's a hedge. So below 50 IV, does it make more sense to buy the contract with the hedge or without the hedge? Without the hedge. Makes more sense. Statistically, IV is going to go up more than go down here. 34.4 is below 50 and an IV rank of 18.6 means hell yeah, this thing has a better shot of expanding implied volatility than contracting. So if the money is okay, if the position sizing is not being overrun, right? If $1,400 by twos does not kick you out, buy the fucking call. Buy the call. Why? Because if you had bought call debit spreads, which some guys did in TTI because it's an expensive trade, and you bought the original play at 385, well, you sold right here. I think we made 300 to 400% on the spreads. It was a great trade, don't get me wrong. But let's say you held that. Did you capture this gap up? Fuck no. You're capped on profitability. You have a max profit. What is a straight calls max profitability before I pull up the chain? What is a call, just a naked calls max profitability? Theoretically. Infinite. It's infinite. Infinite. So if you had held call debit spreads through ER, you would have made a couple bucks because I don't believe we sold right at the perfect point or whatever. It's very hard to hit max profitability until the contracts are about to expire. Would have made a couple bucks extra. But the trade wouldn't have went from 500 to 1,000. Because as the 380 call goes up in value, the 385 call goes down in value because you're selling a call, and when price goes up, that means that contract's value goes down, and that's bad. So when we go back to the chain here, and I ask you again, if you have the amount of cash in your portfolio to be able to size into these trades, 2, 4, 6, 8, 10, and it's a low IV environment, is it better to call debit spread or call? It's better to fucking call. So that's what Dustin did. That's why you see the massive win that he has on the books, because there was no call debit spreads. And we did have guys in call debit spreads. It's a function of how much cash is in your account versus your 1R, the implied volatility, and the IV rank. I mean, that's it. But these are more advanced decisions that you have to take. These aren't the hardest decisions you're going to have to take. But if you're in TTI, this is a decision you have to take. It's a lot harder than hopping into Discord and going, what are we fucking buying today? You're going to learn how to do all of this shit. And that was potentially a 6-figure decision that Dustin made. So once again, going back to Discord, if I were to search for his name on here and you could see the timeline of him managing this trade, it's funny. As a matter of fact, I want you guys to see something really quick, because I want to end this webinar with this. Where is it? Right here. Here's his 3-month P&L. This is prior to the meta. 133%. He had a really good Q4 and into Q1. That's his account. It's 3 months. So last year he ended up 97%. This is just like a subsect of that showing into January. Obviously, a lot of that is the meta, but this was before meta actually had the big ER event. But something that we talk about in TTI all the time is about risk. The last thing I want to say before I stop this webinar, guys, is that we should all be very mindful of risk. It's the most important thing when it comes to trading, because if you blow your account, you're out. That's it. Unless you want to reload like a sucker, you need to always be managing risk. But one thing that I see time and time again is that too many traders are afraid to lose. And I don't know how to tell you this. You are not just a trader. You are a professional risk manager at all times. And to sum Dustin up, if you want the big wins, you need big balls. We have women traders in TTI as well, and they get the same speech. You want to make money, you have to risk money. And that's what it comes down to, but do it logically. So guys, I hope this helped. It's been about an hour. I'm going to call it the full session here on Meta. I tried to talk through it the entirety of the year. I tried to go through every part that we traded, the thought process behind it, the setup, the COD setup. This is very valuable information. You can implement this. I basically went through it. Go and do some back testing on it. Why we decided to front run. Go back and pause the video. Read the actual trade idea as we wrote it up November 2nd. Why we decided to front run it comes back to sector, industry, and relative strength. Second pillar of TTI. Why calls over call debit spreads if you can afford it. How to manage a winning trade to turn home runs into grand slams, and the thought process there. It's not just fucking YOLO. There is an in-depth thought process there. And then when you find yourself in a situation like this, how do you effectively manage it? Because it's difficult. Guys, my name is Hamilton. I'm here with the Trading Initiative. If you like this type of content, please like and subscribe. Leave a comment below. If you're interested in our services, both links are down below: market research and trader development program. Thank you for joining me. It's Saturday. I hope you guys enjoy yourself.